welcome. In this video, we will be discussing how the transitional GST rate change will affect businesses. As announced in Budget 2022, the GST rate will increase from 7 to 8% with effect from 1st January 2023 and 8 to 9% with effect from 1st January 2024. The GST rate hike will affect all businesses regardless of whether the business is GST registered or not. In this video, we will discuss the impact to businesses that are GST registered. While GST-registered businesses can recover any GST they've incurred on their purchase, the GST increase will still have an impact on those businesses. Firstly, businesses will need to update its price display, invoices, contracts, and advertisements to reflect the new GST rate after 1st January 2023. There will also be transitional rules to transit to the new rates. Businesses will need to understand the transitional rules such that they are applied correctly. The Inland Revenue Authority of Singapore, or IRAS in short, has published an e-text guide on 18 February 2022 relating to the 2023 GST rate change. The guide explains the general transition rules applicable to transactions spanning the first rate change on 1st January 2023. The same transitional rules will apply to transactions spanning the second rate change when the GST rate is increased from 8 to 9% with effect from 1st January 2024. The IRAS will be publishing a separate e-text guide to prepare businesses for the second rate change. Therefore, businesses will have to ensure that they understand the transitional rules in order for the correct GST rate to be applied for transactions spanning across the rate change. In a similar vein, businesses will need to review its contracts with customers to ascertain whether the contractual terms allow the new rate to be applied. Such contractual terms may have an impact to how the GST is accounted for supplies taking place after the rate change. Next, businesses are strongly encouraged to start preparation early for a smooth transition to the new GST rate. For example, businesses may need to modify its point of sales, invoicing, and accounting systems to reflect the new rate. Lastly, a higher GST rate comes with higher penalties for GST non-compliance. This is because the GST penalty is usually imposed on the quantum of the GST underpaid or overclaimed. It is therefore crucial for businesses to keep a watchful eye on their GST compliance in order to manage the GST risk. Due to the change in GST rate, businesses must ensure that all price displays, which include price tags, price lists, and advertisements, are updated to be inclusive of the GST at 8% with effect from 1st January 2023. It is important to note that businesses are not allowed to reflect GST at 8% nor issue a tax invoice with GST at 8% before the effective date of the rate change. As there may be practical challenges in ensuring that the GST rate on price displays are updated by midnight on 1st January 2023, businesses can display two price tags. For example, one applicable before 1st January 2023 showing price inclusive of GST at 7% and the other after 1st January 2023 at the updated rate of 8%. By adopting this approach, it will provide businesses with more time to prepare the price display ahead of the rate change on 1st January 2023. The IRAS has provided guidance on the transitional rules for supplies spanning the rate change for businesses to apply the correct GST rate. It has also provided numerous examples in the e-text guide on how the transitional rules should be applied for different scenarios if a transaction spans the rate change. Businesses should not presume that the GST rate hike is a straightforward process and the rate change would only require a tweak in its accounting and invoicing systems from 7 to 8%. Therefore, it is crucial for businesses to understand fully the transitional tax rules and charge the correct GST rate under different scenarios in order to manage its GST risk. In essence, the GST transitional rules will be applicable for transactions that span a GST rate when one or more of the following events straddles the date of the rate change. For example, if an invoice is issued before the rate change but the delivery of the goods and receipt of the payment is after the GST rate hike on 1st January 2023, the supplier will be required to account for GST at the new rate of 8% under the transitional time of supply rules. In addition, there are situations where a supplier can make an election to the IRAS for the GST to be charged at the current rate of 7% if the basic tax point occurs before the GST rate hike. These scenarios are likewise provided in the IRAS e-text guide. A legal contract is a legally enforceable agreement between two or more parties. Due to the rate change, it is necessary for businesses to review contracts spanning the rate change and ascertain whether the new rate can be applied under the contractual terms. For example, if there is an existing contract to supply goods or services on or after 1st January 2023, businesses can increase the contractual consideration to charge GST at 8% if it does not specify that any tax change is excluded or has already been taken into account. On the contrary, if the contract does contain such express provisions, businesses will be bound by the contractual terms and will not be able to revise the consideration. Should this happen, businesses will have to account for the GST payable based on the tax fraction of 8 over 108 multiplied by the total consideration. In this illustrative example, we examine how the terms of the contract may impact the accountability of the GST payable to the IRAS. A tax invoice is issued before the rate change on 1st January 2023 and GST of 7% is charged on the consideration. However, the payment is received and goods delivered after the GST rate hike on 1st January 2023. Under the transitional time of supply rules, the supplier is required to account for GST at the new rate of 8% on the entire value of the supply by issuing a credit note and a new invoice to the customer. However, if the existing contract with the customers has specified that any tax change is excluded in the contract, the GST would have to be accounted for based on the tax fraction 8 over 108 multiplied by the consideration of $10,700. Accounting software and retail management systems can help businesses to digitalize its business processes, comply with record keeping, and other tax obligations. Such tools are important in helping businesses manage their GST risk and applying the correct GST rate, since transactions for businesses can be voluminous. Businesses should proactively engage its outsourced IT vendors or in-house IT team early to discuss how their accounting and invoicing systems can be updated due to the rate change and come up with a concrete plan and timeline for the implementation of the system. It is important for businesses to reach out to the IT vendors early and not at the last minute, as the IT vendors may also be swarmed with the same requests from their other customers. Businesses can also explore funding support for pre-approved solutions such as the Productivity Solutions Grant on the implementation of these accounting systems. For more information on eligibility conditions, lists of supportable pre-approved solutions, and how to apply for the grant, businesses may refer to the Go Business webpage. Lastly, a GST rate hike may result in higher penalties for businesses in the event of non-compliance. For example, if a business has overlooked its GST payable to the IRAS by the payment deadline, a late payment penalty of 5% will be imposed on the GST payable or overclaimed. Prima facie, a GST rate of 8% would mean that the penalty computed will be higher as compared to a penalty computation based on a 7% rate. There may also be situations where business revenue is impacted from GST non-compliance further to the GST rate hike. For instance, there was an error made by a GST registered supplier which had incorrectly zero-rated a supply instead of standard rating the supply. The supplier will need to account for the GST payable to the IRAS under the GST inclusive method. By computing the GST payable to the IRAS using the GST inclusive method of 8%, the GST payable to the IRAS will be higher as compared to the calculation based on 7%. Prima facie, the reduction of the revenue of the GST supplier will be more as compared to a situation where the GST inclusive method was computed based on the current rate of 7%. Due to the potential higher penalties arising from non-compliance from the GST rate hike, it is important for businesses to stay on top of its GST compliance going forward. If there are any errors discovered, GST registered businesses can consider the Voluntary Disclosure Program, or VDP in short, to voluntarily disclose the errors to the IRAS subject to meeting the prescribed conditions. By doing so, businesses may be able to obtain a reduction or waiver in penalties arising from the non-compliance. There are also various schemes such as the IRAS Assisted Compliance Assurance Program, or ACAP in short, or the Assisted Self-Help Kit, or ASK in short, where GST registered businesses can consider such schemes to conduct a self-review on its own GST internal control framework and improve its GST processes. In order to ensure that businesses take steps early to prepare themselves for the impending GST rate hike and a smooth transition to the new GST rate, the IRAS has provided a checklist on what businesses should do to prepare for the GST rate change. The GST rate hike in Singapore is not new, and the last GST rate hike took place in 2007. As there were teething issues arising from the GST rate hike that took place more than a decade ago, it is strongly encouraged that businesses start their preparations early for a smooth transition to the new GST rate and thereby reducing its GST risk exposure. That concludes our discussion on the impact to businesses that are GST registered. We thank you for your time and hope that you have found this video to be useful and insightful for you in navigating these new developments as well as in preparing your business for the impending changes to remain compliant. Should you have any questions, please reach out to us via email at tax@crow.sg. Thank you.